Hi guys, welcome or welcome back to my portfolio update from March. Last month was pretty brutal in general and also for my portfolio. On a month-over-month basis, my portfolio is deep in the red and one of my stocks even cut their dividends. But I also had one new buy that is even a brand new position in my portfolio, and I also had a look at the dividend yield on cost for some of my stocks. That means we have a lot to talk about, so let's jump right in. My name is Florian. Thank you for joining me today. The S&P 500 and the Nasdaq had their worst months since 2022. The major driver for this were the Magnificent Seven that still make up more than 1/4 of the S&P. These stocks even had the worst months and the worst quarter on record. Over the course of March, the Nasdaq declined by 5.7% and the S&P by 4%. Even the MSCI World declined by 3.2% now, in contrast to the last month where at least the MSCI World was still slightly green. This has pushed all three of these indices down to roughly the same levels they had by middle of last year. And this month, the crash didn't even stop in Europe. In contrast to February, where European stocks were still strong, now even the Euro Stoxx 600 also declined by 4.5%. But at least this index is still up since the beginning of the year. In the performance map of the S&P, we see that not everything was bad last month. Yes, the majority here is deep red, but the more defensive stocks like healthcare, energy, utility, and to some degree also consumer stocks are still green. So, despite the bad overall performance, there were still some gems to be found, and the picture shows that many investors were seeking refuge in defensive stocks. In my case, I started the month with a total portfolio value of 121,636 euros, split between 70,305 euros in ETFs and 94,330 euros in individual stocks. By the end of the month, the total portfolio had declined by 7.4% and is now sitting at 130,138 euros. The decline with my ETFs was with minus 8.9%, quite a bit higher than my stocks that declined by minus 7% only. So the last month was quite tough for me, and in fact, it was the worst month I had since I started my detailed tracking. But I have also already lived through the financial crisis in 2008-2009, even though my total portfolio value back then was much smaller and I did not track it in any detail. In fact, I barely even had a look at my portfolio that mostly consisted of ETFs and only one individual stock back then. But it is still good to know that this has already happened in the past and that we will also recover this time. It is also good to see that my dividends still kept flowing in. We will go over all 5 dividend payments I received last month in just a minute, but first, let me show you what I bought last month. With Novo Nordisk, I only bought one company last month in addition to my savings plan in the S&P, but this one is a brand new addition to my portfolio. I started this position with a total of 34 stocks that I bought on 20th of March for a total value of 2,494 euros. Novo Nordisk had some very bad months since the middle of last year and did decline by more than 50% from the highs in the middle of last year. I think that the stock is way oversold by now, mostly because of worries about their weight loss drugs. The trade tariff discussion doesn't help either. But over the long run, I still think that they have huge potential, and with their insane dividend growth of 90% annually for the last 5 years, they are a perfect match for my portfolio. And if you've been watching my videos from the last month, you know that my plan is to further decrease my weight in US and in tech stocks. And this buy will also help me to do this. And speaking of the portfolio, let me bring up my portfolio X list here. The first thing to note is that my S&P ETF did a lot worse than the SPY that I showed in the beginning of the video. Instead of losing minus 4%, my S&P ETF actually lost 9%. The main reason for this is that I chose an ESG selected S&P 500 here instead of the plain old SPY. Up to now, the performance of the two was pretty much the same, but last month I noticed this huge difference for the first time. This was also not my intention when I chose this ETF, so I am debating now if I should switch it to a regular S&P 500 or even replace it completely with another more globally diversified ETF like the MSCI World or the FTSE All World. The S&P 500 was a good choice for the last decade, but as the research that I talked about in my video from last week shows, it might not be the best choice for the next one. From my individual positions, there are even a couple of stocks with a performance of almost minus 20%. The worst one was the small cap Surgical Science Sweden that, even though it's a European company, has their largest customer in the US with Intuitive Surgical. Then we have Nvidia that is also down by over 19%, followed by the next Mag 7 stock Meta with minus 19.12%. Actually, all of my tech and semiconductor stocks had a very poor performance, with TSMC, Texas Instruments, ASML and also Microsoft being in the worst third of this list. The only 3 stocks that had a positive performance when we exclude the dividend payments were all European companies. Here we have Ahold Delhaize, where I just increased my position in last month, Deutsche Post and Energiekontor under the best performers. Energiekontor was even up by 40% for a couple of days, but gave away most of this performance again in the last days after they released their numbers for the last fiscal year that didn't do so well. We'll talk about these earnings in a bit, but first, let me show you the dividends that I received last month. On the 4th of March, I received €11.21 from Visa. On the 13th, I got a similar amount of €11.52 from S&P Global. And Microsoft followed on the 14th with €70.43. My biggest payer last month was NextEra Energy with €37.39. And Meta closed the month with a payment of €2.10. So overall, I earned €79.65 over the course of the whole month. This may not sound much, but it still means that I closed the first quarter with more than double the dividend payments as last year. I actually started my detailed tracking in the first quarter of 2023, where I got paid a bit over €100. By last year, this had grown to €150, mainly because I sold out of my biggest dividend payer from 2023. This year, this was more than double, with €263.72 of total dividends in this quarter. And what I find pretty encouraging by now is that my dividend growth strategy is starting to show the first results. In this 3-year data, there are several companies that show some very nice dividend growth, even though the yield might not be too high. When we look at my first position, Microsoft for example, we see that except for the first quarter, a nice and steady uptrend of the dividend payments, even though I did not add any new shares to my position. And this trend can also be seen for several of my investments that I have for several years now. With Microsoft, for example, that I have owned since the beginning of this tracking, the current dividend yield sits at 0.88%. My average buy value for the whole position was €4,777, and in the last 12 months they paid me a total dividend of €56.04. That leaves me with a yield on cost, or personal dividend yield, of 1.2%. JP Morgan, that I also own since the beginning but added some shares to in early 2023, had an average buy value of €3,709 and paid me €223.84 over the last year. That brings my personal yield to 3.3%, which is 1/3 above the current yield. And both of these companies are not specifically known for a huge dividend increase. Visa, on the other hand, is known for its dividend increase and could grow their dividends by 15% annually over the last 5 years. I entered my position here in the last quarter of 2023 and added some shares again in the second quarter of 2024. So my last purchase was not even 1 year ago. My average buy price on this position is €4,765, and in the last 12 months they paid me a total dividend of 35.55. This leaves my personal dividend yield with 0.74%. That is a growth of about 10%. Not too bad for a position that I don't even own for a full year yet. But what should you do if one of these dividend growth companies cuts their dividends all of a sudden? Unfortunately, this just happened last week with one of my most promising dividend growers that just announced such a cut in their last earnings call. The companies that reported their earnings last month were JD.com and DHL on the 6th of March and Energiekontor on the 28th. The report from JD.com was basically as expected. They did show a year-on-year double-digit growth in top and bottom line, which was mostly in line with the last years. DHL reported mixed numbers for the last year and a not so optimistic outlook for the next one. But they also started a cost savings program and increased their currently running share buyback program, which was well received by investors. The stock jumped by almost 15% after the earnings call, but has given away much of this performance since then again. I still have not made up my mind if I should keep them in my portfolio or sell them. Because I do think that they will have a tougher time for the next few years and I don't expect too much growth. But on the other hand, even with the lacking growth, they are still paying quite a high dividend that acts like a safety anchor for my portfolio. But the biggest surprise came with Energiekontor. They couldn't manage to close some deals late last year, which severely impacted their business. Their sales declined by 47% year over year, their EBIT by 65% and their EPS even by 73%. And unfortunately, this has forced them to cut the dividend by around 60%, even though at the same time they increased the payout ratio from 30% to 43%. And of course, this is something that I as a dividend growth investor don't want to see at all. And that is also in stark contrast to the dividend growth of 25% that they had over the last 5 years. But despite the dividend cut and the projects that they could not close last year, their development pipeline still looks good. Yes, the project sale is down, but these projects are not dead, but are in the last stages of closing the deal. And the size of all the projects in their pipeline is well above the size measured in capacity from last year. The capacity from their own portfolio has also increased and there are many more projects under construction for their own portfolio as well as commissionings from other customers. All of these numbers are well above the ones from last year. And despite them only achieving a bit over half of their target EBIT in 2024, their growth strategy for 2028 is still intact and they expect that they will at least achieve their targets for this year. Here we also see that one reason for the huge decline in numbers is actually a big overshoot in 2023. But over the course of several years, this high year-to-year volatility should smooth itself out again. And we should not forget that Energiekontor is a small cap, so we should expect a higher volatility compared to bigger companies. For the current fiscal year 2025, the company has raised their guidance and expects their project sales to catch up again and maybe even surpass their original expectation. But the variation in the forecast is also quite large with over 20%. So even though I am honestly a bit disappointed by this year and the dividend cut, I still think that the long-term outlook for the company is still good, and with the increase in their own energy production capacity, their resilience against such project delays should also get better over time. On the other hand, their expansion plans to the US might get hurt or be delayed again under the current Trump administration. But at least analysts are still pretty bullish on the stock and also see a recovery in their financials and their stock price over the course of the next year. I have thought about selling my stocks in Energiekontor as long as I'm still in the red for tax loss harvesting, but I've decided that for the time being I will still keep my position, but I will observe the development of the business very closely this year. After my new buys in the last month, the stock now makes up 5% of my portfolio and has reached my rough target position size. So for the time being, I'll also not add any new shares. Compared to last month, you can see my new position in Novo Nordisk with 2% of my portfolio. This came at the cost of mostly my big techs, Nvidia, Microsoft and Meta that all slightly lost some share. But for next month, I'm not sure if I will do any new buys. The market is pretty crazy right now and the trade tariff roulette of Trump is still rolling. So I expect a high volatility, but I'm not sure if we have seen the bottom in the current crash already. I have entered my first position in Novo now, and even though I still want to increase this, I am not yet in a hurry to do so and would rather wait to see a bottom before further increasing my position. But in general, I'll still keep investing and I will also let my regular savings plan in the S&P run as usual while keeping a look on the markets for any chances. One of the stocks that I am currently observing and waiting for a bottom in is still Prysmian. And as I mentioned earlier, at the moment I still see the chances rather in Europe and Asia compared to the US. There is actually a lot of data that indicates that the US will underperform not only this and next year, but even over the next decade. And last week I made an in-depth video where I analyzed several research papers and statistics to give a better understanding of the reasoning and the underlying trends for this. If you want to make your portfolio ready for the next decade in a changing global environment and want to learn about the backgrounds that are driving this change, please feel free to check it out right here. That being said, thank you so much for watching, guys, and see you in the next video.